Okay, just picture this for a second. You're standing on the very edge of a high dive,
Okay.
and to your left, the pool is, I don't know, maybe running out of water. And to your right, there are these storm clouds gathering that look suspiciously like a hurricane.
And your coach is on the side.
And your coach screams, "Just freeze! Don't move a muscle!"
That is a vivid and, honestly, a pretty stressful way to start the morning. But given the news we're covering today, I can't say it's inaccurate.
It feels pretty spot on, right? Because we're looking at the news from yesterday, January 28th, 2026. The Bank of Canada has officially held its key interest rate at 2.25%.
Frozen on the diving board.
Exactly.
And this is the second consecutive hold, too.
Yeah.
So the overnight rate is 2.25, the bank rate is 2.5, and the deposit rate's at 2.2%.
And for anyone who just sees that headline and thinks, boring, nothing happened, I feel like we just need to stop them right there. This isn't some, relaxed wait and see.
No, not at all.
This is a white knuckle, sweating bullets kind of pause.
Absolutely. The headline might be unchanged, but the subtext is high alert.
So that is our mission for this deep dive. We aren't just looking at the number. We need to figure out why the bank is, paralyzed. We're going to unpack this really weird domestic economy. I mean, people are spending money, but businesses are terrified to hire. And then we have to tackle the massive shadow looming over everything.
The United States trade policy.
That's the one.
And we have a lot of sources on the desk for this. The bank's own announcement, of course, some deep analysis from RBC Economics, forecast scenarios from Oxford Economics, and even some on-the-ground legal insight from Samfuru Tumarkin on what this actually means for jobs.
Okay, let's start with the decision itself, 2.25%. Staying put. But I have to call out something that it jumped out at me in the data, and frankly, it seems like a contradiction.
I think I know where you're going with this.
The inflation number. The data shows inflation actually ticked up to 2.4% in December of 2025.
Right.
So usually the rule of thumb is inflation goes up, you raise rates to cool it down, or at least you talk tough. But the bank just sat on its hands.
Mm-hmm.
To the average person, doesn't that look like they're asleep at the wheel?
On the surface, it definitely looks like a mixed message.
Mm-hmm.
But this is one of those times where you really have to look under the hood, The headline number is genuinely misleading.
Okay, so pop the hood. What are we looking at? Why is 2.4% not really 2.4% in their eyes?
It all comes down to something called base year effects. It sounds technical, but it's just a quirk of how we measure things year over year.
Okay.
Think back to last winter, late 2024, early 2025. Do you remember the federal government did that temporary GST, HST holiday?
Oh, vaguely, yeah. It was a break on essentials, I think.
Exactly.
Yeah.
So for that short period, a year ago, prices on a lot of things were artificially low, cheaper, because the tax was gone.
Right.
Now, fast forward to today. We're comparing today's normal prices with the tax back on against that artificially low period from last year.
I get it. So the gap between then and now looks huge, but only because the starting point, the then, was unusually low.
Precisely. It creates this, statistical illusion of a spike. It's a ghost in the data. If you strip those tax changes out and look at the real pulse of inflation, it's actually been slowing for months.
So the bank sees this 2.4% figure and just says, nope, that's a blip, not a trend.
That's the bet. They expect it to settle back down near the 2% target once we move past these statistical hurdles.
Okay, so that explains the inflation side of the puzzle, but then there's the growth side, and this is where that frozen on the diving board metaphor really kicks in for me.
Mm-hmm.
We had a decent third quarter in 2025, but looking at the Q4 estimates from RBC and the bank, it looks like we just completely ran out of gas.
Ran out of gas is putting it politely. We stalled.
Okay.
The estimates for the fourth quarter are showing growth dropping to effectively 0%.
Zero.
Flatline. And that momentum shift is critical. You can really feel it in the labor market.
Mm-hmm.
Unemployment is sitting at an elevated 6.8%.
And I saw they specifically flagged youth unemployment as a major concern.
It's incredibly difficult for new people entering the workforce to get a foothold right now.
But here's the part I'm struggling with. If growth is zero and unemployment is almost 7%, you would think consumer spending would be in the toilet.
You'd think.
But the RBC report suggests domestic demand, people buying stuff, is actually holding up okay. How do you get resilient shoppers but paralyzed businesses?
And that is the huge disconnect defining this moment. Consumers are surprisingly resilient. They see rates have stabilized and maybe they feel a bit more confident.
Okay.
But businesses, they look at the horizon and see nothing but risk. So they aren't investing and they definitely aren't hiring. because they have no idea what the rules of the game will be in 6 months.
Which brings us to the real reason for the paralysis. You can't talk about the Canadian economy right now without talking about the United States.
You really can't. It's the elephant in every single room.
It feels like every time Governor Macklem opens his mouth lately, he's just trying to politely scream, "We are terrified of what's happening in Washington."
He used the phrase heightened uncertainty.
Yeah.
And we should be specific about what that is. It's not some vague market vibe. It's trade policy.
Right. Specifically, the threats coming from U.S. President Donald Trump. There was that threat of 100% tariffs on Canadian goods if we pursue a trade agreement with China.
100%. That's not a tax. That's a wall. It just deletes trade.
That's a wall. And then on top of that, you have the scheduled review of CUSMA, the Canada-United States-Mexico agreement, coming up in July.
It's a ticking clock.
And Macklem had this quote that I underlined it 3 times because it felt like a confession. He said, "Monetary policy cannot compensate for the structural damage caused by tariffs."
That is the key sentence of the entire announcement. Let's break that down.
Yes, please. Because we treat the Bank of Canada like the mechanic of the economy, right?
Yeah.
If the engine runs hot, you raise rates. If it's cold, you lower them. Macklem is basically saying, I can't fix this car.
He's admitting his toolkit interest rates.
Yeah.
It only works on demand. It makes borrowing cheaper or more expensive. But if the U.S. government slaps a massive tariff on Canadian steel or lumber, those industries lose their customers overnight.
Lowering interest rates doesn't get those customers back. It doesn't reopen the border.
Exactly. So if a tariff destroys a factory's business model, offering them a cheap loan, what good is that, really?
It might keep them on life support, as he said, to support the adjustment.
It can't reverse the damage. And that is why the bank is frozen. They are waiting to see if the fundamental rules of trade are about to be completely rewritten.
And this is where the Oxford economics analysis comes in, which I found fascinating. Because the bank has its base case, what they're hoping for.
Right.
But Oxford ran the numbers on the nightmares.
The bank's base case, their official projection, it assumes the status quo holds. So, current tariffs stay, but the big CUSMA exemptions stay too. In that world, we just limp along with maybe 1.1% growth in 2026.
Which is barely moving. But tell me about the dark scenario. What happens if those talks in July completely blow up?
Oxford Economics modeled it. If CUSMA gets torn up, or we just revert to standard WTO tariffs, they project a huge hit to GDP.
Like a recession.
Like a full-blown recession, yes.
And what would the bank do then?
They'd have to switch from wait and see to full-on emergency response. Oxford suggests they would cut rates aggressively, probably by another half point, maybe more.
Not to fix the trade war, but just to keep the lights on.
To keep the financial system from seizing up, they stop being a manager and start being a trauma surgeon.
That's a terrifying image. But, okay, let's play devil's advocate. Is there a world where this breaks the other way? A sunny scenario?
Surprisingly, yes. If the trade tensions just resolve, cooler heads prevail, tariffs get dropped, the CUSMA review goes smoothly, that massive cloud of uncertainty just evaporates.
And all the business investment that's been sitting on the sidelines comes flooding back.
Right. And if the economy suddenly booms...
Then the bank has the opposite problem on its hands.
Exactly. Inflation could roar back. In that positive scenario, Oxford thinks the bank might actually have to raise rates by 0.5 percentage point a year from now.
This is just wild. So we're standing here at 2.25%, and the next big move could be a deep cut or a significant hike.
And it depends almost entirely on political meetings happening in Washington and Ottawa.
It's not about the economic data anymore.
That's why the bank calls itself firmly neutral. They aren't leaning one way or the other because the data that matters most right now is political, not economic.
Okay, so while the central bankers are staring at the horizon, the rest of us are, living here. I want to talk about what this paralysis means for our listeners right now.
Let's start with borrowers.
Yeah, I know a lot of people with variable rate mortgages were just praying for a cut yesterday. That was not a good day for them.
No relief. Prime rates stay unchanged. And Money Mentors had a really insightful take on this. They said, holding rates here doesn't solve the debt problem for households.
It just freezes it.
It freezes it. Exactly. It freezes the situation. You aren't drowning, but you are not swimming to shore either. You're just treading water with this weight around your ankles.
It creates a state of almost okay.
Almost okay. People can make their payments, but they aren't really getting ahead.
So what about the housing market then? We've heard for 2 years that high rates kill housing. If rates aren't dropping, Is the market just dead in the water for 2026?
Well, counterintuitively, maybe not.
Yeah.
The BC Real Estate Association is actually forecasting a modest rebound this year.
Even with the hold.
Yes, it seems to be psychological. Buyers have been on the sidelines forever waiting for the perfect bottom, but eventually, life just happens.
You get married, have kids, you need to move.
Exactly. There's pent-up demand that's likely to break loose, and we might see prices inch up just because inventory is still so tight.
Okay, I want to bridge the gap now between that high-level trade war talk and actual paychecks. Because when we say business uncertainty, it sounds so abstract.
Yeah.
But we have a very concrete, real-world example of what that looks like.
You're thinking of the GM news.
I am. General Motors is cutting the third shift at the Oshawa plant this year. That could be up to 1,200 workers affected.
And this is where the macro meets the micro. Why does a company cut a shift? Because they're adjusting to softer demand and, critically, preparing for that structural uncertainty we talked about.
If you don't know if you can sell your cars to the U.S. next year tariff-free, you lean out your operations now.
You don't wait to find out.
And this is where that Samfir Tumarkin data becomes really relevant. Not legal advice, obviously, but they highlighted a distinction that I think a lot of people miss. The labor market is sort of split in two.
Right. It's bifurcated. On one side, you have those GM workers. They're unionized. Their layoffs, their recall rights, their severance. It's all dictated by a collective agreement. It's a negotiated safety net.
But then you have the other side, the majority of that 6.8% unemployment figure.
The non-unionized private sector. And this is where a huge misconception lies. A lot of people think if they get laid off in this stall, they just get the 2 weeks per year of service that's in the Employment Standards Act.
Which is the bare minimum.
The absolute bare minimum. But they point out that common law severance can be significantly higher. I mean, up to 24 months' pay in some cases. The point is that in a stalled economy, employers might try to lowball exits to save cash. Understanding your rights is crucial.
It's a good reminder that the unemployment rate isn't just a number, it's a really complex landscape.
Absolutely.
So let's look ahead. We're stuck at 2.25. The bank is staring at the storm clouds. How long do we stay in this freeze?
Well, if you ask RBC Economics, you should get comfortable. Their prediction is that the bank holds steady at 2.25% through the entirety of 2026.
The whole year. Wow, that feels like an eternity in this climate.
It does. But barring a catastrophe or, I guess, a miracle on the trade front, they see no real reason for the bank to move.
And the markets agree.
The markets seem to.
Mm-hmm.
Traders are pricing in only about a 5% chance of a cut in March. Basically, nobody expects movement soon.
And the next scheduled announcement is March 18th, so we have a couple of months to watch the data.
And more importantly, to watch the political headlines coming out of Washington.
Right. So let's just wrap this up. The bank holds. Inflation is technically up, but it's actually cooling. The economy has stalled, but the real monster under the bed is external.
That's the summary. We're in a period of what they call structural adjustment. The economy is trying to reshape itself to survive in a more protectionist world.
You know, it really challenges the way we've been taught to view the economy. For 30 years, we've looked at the central bank governor as the pilot, right?
Mm-hmm. The one in control.
If the economy's too hot, they cool it. Too cold, they heat it up. They're at the controls.
You know.
After this deep dive, especially hearing Macklem just admit that interest rates can't fix tariffs, I'm left with a pretty unsettling question.
Which is?
Who's actually in the driver's seat of our economy right now?
It's a valid question.
Is it the Bank of Canada? Or are our mortgage rates, our job security, the price of our groceries? Are they now entirely dependent on a trade negotiator in a room in Washington?
I think we're realizing that the levers of power have shifted. The economists are sort of stepping back, and the diplomats, or the lack thereof, are taking the wheel.
That is a provocative, if slightly terrifying thought to leave you with. We'll be watching very closely as we head toward that March decision. Thanks for diving deep with us.
Thanks for having me.